Yo, what's up, guys? This is your boy Kintech, aka the Rising Star. We are back again. Today is the second day or day two of our free Forex Bootcamp for beginner traders and also intermediate traders. Yesterday, we talked about what is Forex, we talked about currencies, major currencies, and minor currencies. So, in today's discussion, we are going to be talking about lot sizes, pips, leverage, and trading sessions. So these are the things that we are going to be talking about in today's session. So make sure you give me your attention so that I can take you guys through all these things that you need to become a profitable trader. Understand? So let's start with pips. So normally, what is pips? When you hear pips, what does pips mean in forex trading? This is very simple. In the forex market, as I said yesterday, currencies are being paired against each other to determine which one will be stronger than the other in a given period of time. So, how do you know that this currency is stronger than this currency? Simple, by comparing the economical status of that nations. You understand? Your economical status of your country or the economical status of your country determine the strength of your currency. If your country economy is performing well in the global market, it means that your currency will be what? Very strong in the forex market. The currency will have much value, which will attract more investors into the country. But when your economy is not performing well, the same way your currency will be also what? Performing poorly in the forex market. Understand? So because of that, nations have been in what? In the stages. In the stages, we have already developed nations and still developing nations. So countries that have been regarded as developed nations, already developed nations, their currencies are very strong and reliable than still developing nations. You understand? So, for instance, if you have, let's say, $1 and you want to exchange it for Ghana cedis, because of the differences between this economical growth between America and Ghana, the value of that particular dollar is stronger than the value of the cedis. It means that if you have $1 and you want to exchange it for Ghana cedi, you are not going to get one Ghana cedi in return. Why? Because the Ghana cedi doesn't have much value or strength as compared to the dollar. You understand? So as we speak right now, the exchange rate or the conversion rate of $1 to Ghana cedi is this thing, 10.5, which is 10 to the 50 pesos. You understand? So in the forex market, this exchange rate or these price differences that happen between currencies is what we call the pips, which means that percentage interest points. You understand? So basically, what I can just say about pips is that pips used to measure the exchange differences or the differences that exist between currencies, the circulation price of currencies. This is what we call the pip movement. So when a currency moves from an exchange amount or figure to a different one or to another exchange figure, for instance, if the exchange of let's say $1 to Ghana cedi is 10.50 right now. So in future, if the exchange rate moves from 10.50 to 11 Ghana cedis per dollar, it means that it has moved in what? In distance in 50 pips movements. You understand? It means that it has dropped what? 100 pips movements. You understand? So this is how we calculate what pips in the market. So I'll be showing you with examples. The another thing that we have to also talk about is what? Lot sizes. What are lot sizes? Lot size simply means that the unit of quantity of transactions you want to do in the market. If you want to trade as a trader, you don't trade in a single commodity or in a single quantity, because the exchange rate that happens or the fluctuation of this exchange rate, which is very small and tiny, is not big enough to give you a reasonable profit when you are going to transact in a single unit or single quantity. You understand? So that is why in the forex market we transact in a larger units of quantities, the minimum of 1,000 units of quantities. You understand? So lot size simply means that how much you are going to buy. For instance, you want to buy, let's say, maybe a motorbike. You have come to a dealer to buy a motorbike. The person asks you, how many do you want? You understand? So the amount of money that you will give is depending on what will determine the amount of bikes you will get in return. So the pips tells the broker the amount of quantity you want to transact in. So that is why in the forex market, if you use a smaller lot size, and if you use a smaller lot size, the outcome or the gains will be very small. The same way, if it goes against you, the losses will also be what? Very small. But when you use a bigger lot size, if the market goes in your favor, you will make enough profit. You will make reasonable profit or reasonable gains. The same way around, if market goes against you, you are gonna wipe out your trading accounts. You are gonna lose everything. So it is not advisable to be using a bigger lot sizes because it can help your risk management. And forex is about risk management. Use a lot size that has a what? A low risk impact on your account. So when you get to the advanced level, we'll talk much about these lot sizes, which are the preferable lot sizes to use based on your account size. If you fail to understand lot sizes, there's no way you can manage your risk well. The same way, if you fail to understand movements, there's no way you can manage your risk well because in the first place, you have to know how many pips will I be risking on this particular trade. And from the pips, you then calculate to know the pip value, the value per pip for that particular currency or currency pair, you understand? Before you can then choose which lot size will I use so that I'm not risking more than 1 to 2% of my account. So all these things are important, which you must know before you can become a good trader. You understand? So another thing that we also talk about is leverage. What is leverage? Leverage simply means that a borrowed fund from your broker. When we say a borrowed fund from your broker, what does this mean? It means that you using small amount of money to control a bigger amount of transactions. For instance, I have $100, but because I have leveraged my account, the power with the use of leverage or the power of leverage, I can be able to control transactions that worth of what thousands of dollars because I've leveraged my accounts. It means that my broker has given me some funds, some capital, in addition to what I have in my account, so that it can boost my purchasing power. It can increase my purchasing power to do more transactions, way more than what I have in my account balance. In the olden days, where there was not leverage or there was no brokerage in the system, so leverage was not applicable. Then you were needing like millions of dollars before you could trade the forex market. But thank God that we have the intervention of brokers in this industry. So with the help of brokers, they provide you with a leverage that can boost your purchasing power, that can increase the strength of your $10, your $100, so that you can also make the same transactions that a person with a bigger account can make. You understand? So this is how leverage works. They increase your purchasing power by multiplying your account size by the number of leverage figure you have chosen. So when you are opening an account, they ask you to choose a leverage. And bear in mind that this thing can go for you, can work for you, can also work against you. If you choose a bigger leverage, you are exposing your account to risk. Chances of you losing everything in your account is very high. So avoid choosing higher leverage numbers or bigger leverage numbers. Use smaller ones that are reasonable. I would recommend 1 is to 500 and below. And anything above that is a high risk to your account. You understand? In nations where the system or the government is more concerned about the citizens of the state, in that countries you can't provide the citizens more than 1 is to 100 or 200 leverage. It can't happen. Countries like US, what I know about them is you can't provide a leverage of more than 1 is to 100 out there. You understand? Why? Because the states want to protect you automatically before you can even start to trade. But other stations or other destinations like Africa, where we are in free range, everybody does what he likes. You can even get a leverage of unlimited. 1 is to 2,000, 1 is to unlimited. You can get more than that. You understand? But it is not bad. You can use it as your advantage. You understand? You can learn how to use leverage properly. When you choose a bigger leverage or a high leverage number, it doesn't mean that you should go ahead and be putting a bigger lot sizes to a trade and be risking anyhow. You can have a bigger leverage number and wait for a perfect opportunity to use it well to make what reasonable or maximum profit with your smallest amount of money. You understand? So another thing that we'll also be talking about will be the trading sessions. There are other financial market where you can trade all the time, 24/7. But in the forex market, it's not like that. It is what 24/5. Why? Because it's trade from Monday to Friday, which are the active days. Why? Because the bigger players in the industry are banks and what hedge funds, bigger financial institutions. And as we all know, these institutions mostly don't work on weekends, on weekends, Saturday and Sunday. So that is why it is recommended or it is advisable to trade from Monday to Friday. You understand? If not BTC, I don't think there's any forex broker that will provide you that will allow you to trade on weekends unless you are trading what derivatives, which is the synthetic aspect. Those ones it is 24/7. You can trade all the time. You understand? So we have trading sessions depending on your geographical location. You understand? Because how the world runs, a night can be some people's afternoon. Your afternoon can be some people's morning. Because of that, we have trading sessions in the market. So these trading sessions have been grouped based on what the geographical differences that happens. You understand? So we have about 4 trading sessions. We have the London session, the New York session, the Tokyo session, and the Sydney sessions. But this Sydney session and the Tokyo session have been grouped as one, have been combined as one, which you call what the Asian session. So basically, we have 3: the London session, the New York session, and the what the Asian session. You understand? So in the Asian session, that's why the Asian continental traders wake up in the morning to trade the market. And most of the time, we those using GMT plus 0, at that time, that will be in our nights. So, me like this, I don't trade in the night because that will be in the Asian session, which make the volatility very low for me to trade. And that time, I also have to sleep so that I can wake up in the morning, have enough strength to trade the market. So, normally, I trade London session and the New York session. With the Asian session, I trade that once in a while. Maybe sometimes when I wake up in the this in the morning around let's say 3 o'clock, 4 o'clock thereabout, if I'm able to get a good opportunity, I can jump into the trade. You understand? But I don't trade it always. Once in a while, when there's an opportunity, or when I wake up too early to do something and there's an opportunity. But with London session, that will be early morning here around 7 a.m. You understand? So I'll enter the market from the 7 a.m. or 9 or any time within the London session parameters. You understand? So getting to 12 o'clock noon, this and the New York session will also open. So New York traders also come to the market, and that is where more volatility will come into the market, more momentum will be in the market because these are the 2 strong market sessions that are trading at the same time. We call it what the overlap of the market. When the London session trades at the same time with the New York session, we call what the overlapping period of the market. That is when market moves very highly. You understand? A lot of breakouts happens out there. So around 9 to 10 thereabouts, the New York session will also close. And before that, the London session will close around 3 o'clock thereabouts, and around and leave this in the New York market to continue trading. So getting to 9 to 10, it will also close. So you have opportunity to trade from morning to evening, so whatever you want. Understand? Provided if it is Monday to Friday, market doesn't close. Starting from Monday to Friday, it doesn't close. You can trade anytime you want. But it doesn't mean that you should be on your chart trading all the time. You must have a specific time frame that you should come into the market to check for opportunities. If there's an opportunity, you trade. If there's no any opportunity, you leave the market. So if you haven't subscribed to my YouTube channel, just please use 1 second of your time to click on the subscription button, turn on the bell notification icon, so whenever I have a beautiful content like this one, you won't be left out. And if you are not part of my Telegram community, just click under the description of the video. You'll get the Telegram link out there. Click on the link and join the winning community. I also have a private mentorship group where I train people. I take beginners and intermediate traders through how to become profitable in the forex market. So if you are still struggling, if you are still suffering, you have been trading for so long without being profitable, just DM me, Kintech. I want to learn how to trade. I'll take you through with my proven strategies, my risk management plans, and my psychological tips that have helped me to be where I am today, so that you too can also become profitable one day.